All right, we're going to jump into credit and credit cards and financial excitement here. And credit, when you talk about people having good or bad credit, it's basically, you get a score and it tells banks or lenders how, I guess, reliable you are in terms of finances. This is my own personal take on it. But if you have a high credit score, you are more likely to get low interest rates. So if you have a high credit score, you're going to pay lower interest on a car loan or a house loan or other things because you're more reliable. So they kind of give you a break, right? And credit cards are similar. If you have a high credit score, you can negotiate lower interest rates and a higher balance and that kind of thing. So section 19 that we're getting into is mostly about credit cards, but we are going to start a little bit in talking about just interest in general and how interest rates can affect different types of loans. So first thing is, the biggest purchase that anybody makes generally is a house. And so we're going to just look at a $100,000 mortgage and a 30-year span. Now, the interest rates here that we're going to look at, we're going to compare a 4%, 5%, and a 6% interest rate. And without looking at anything else, if you just say 4% to 6%, it doesn't seem like that much because it's just 2%, right? That's not a big deal. I hit a wrong button. Okay. If you compare, and they tell you this is already figured for you. Look at the monthly payment. 4%, if you get a 4% mortgage rate, your monthly payment would be $477.42. If you get a 6% interest rate, your monthly payment is at $599. That's a difference of like $122 a month. And the only difference is interest because you're borrowing the same amount of money. So if we borrow $100,000, they show you 30 years in the mortgage, 12 months in a year. This is how much you're paying per month. At a 5% interest rate, you will pay back $193,255.20. That's almost double what you borrowed. So let's look at the 4% interest rate. 30 years in the mortgage, 12 months in a year, and you're paying $477.42. So if you multiply those together, you're going to pay back $171,871.20 to almost $22,000 less than the 5% interest rate. Well, let's look at the 6%. 30 years in the mortgage, 12 months you're paying a year at your monthly payment of $599.55. You multiply those and you're going to pay back $215,838. So the difference between a 4% and a 6% interest rate, so the difference between the 4% and the 6%, was over $40,000. So when you think of, 2% is not that much, well, when you're talking over the course of 30 years and $100,000, it can be quite a bit. So you want to be aware of all that. So how much more? I gave you a roundabout, but if we want to calculate actually how much more, 6% value minus the 4% value, it's a difference of $43,966.80. That's how much more you would pay. I can buy like 3 cars with that amount. So over the course of 30 years, you could buy 3 cars in the amount that you would save by having a 4% interest rate versus a 6% interest rate. Is a 2% higher interest rate result in just a 2% increase? Well, 2% of 100,000 is 2,000. So when we went from 171,871.20 to 215,838, was it just a $2,000 increase? No. It was, I'm going to round, it was like a $44,000 increase, meaning a 2% higher interest rate results in a 44% increase on the $100,000 in this particular example. That's cry. That's why you want to look around and really try to figure out the best deal when you're looking for car loans or house loans or anything else that you're getting money for. Now, finance charges. If you have a credit card, you probably are aware that you can accrue a finance charge. Finance charges basically come if you don't pay your bill on time. So if your bill is due on the 15th and you don't pay it till the 20th, you will incur a finance charge. And different credit cards have different rules on all of that. But for the most part, you have a grace period where you can pay it without a finance charge. And once that grace period has passed, you will owe a finance charge. And a finance charge is calculated in terms of interest. And I would call this bad interest on credit cards. So we talk about the finance charge as interest in terms of an APR, which is the annual percentage rate. So they will tell you that your annual percentage rate for a credit card, it might be 25% or 28% or 10% or whatever. And that's annual. Well, how often do you pay a credit card? You don't pay it annually. You pay it generally monthly. So to make something annual turn into a monthly, you will take your APR and divide it by 12. And now it becomes an MPR, a monthly percentage rate, which is what we will use to find our finance charges on credit cards. So let's go ahead and play with that. So let's calculate the finance charge for a balance of $1,650 with an APR of 23.99%. Now, two things. First off, percent has to get changed to a decimal, and then we have to divide it by 12 to make it a monthly percentage rate. And we'll take that, multiply by our balance of $1,650, and that gets us a finance charge. Recall that we're dealing with money, so you will need to round to the nearest penny. And if this isn't the case, you will pay a finance charge of $32.99, right? This is free money to the credit card company. This is why credit cards like you, because if you don't pay off your balance, you're going to pay a ton in interest. Number 5, let's calculate the finance charge for a balance of $1,650 with an APR of $15.99. Now, this is a smaller percent. Again, percent to a decimal, divide by 12, and multiply by our balance. When we do that, we get a finance charge of $21.99. So you can see the difference in the interest rate and how it affects your finance charge. Right? The difference, $32.99 minus $21.99, that's a difference of an $11. And you may say $11 isn't all that big of a deal. Well, maybe not for 1 month, but over 12 months, over 30 years, it can add up to a lot of money. Credit card fees. Credit card fees can accrue for all kinds of reasons. You could have a late payment. You could have an overdraft fee, right, if you overgo your limit. You could have, what else is there? Return payment. I'm sure there's other things, but generally, if you break any of their rules, they will give you a fee, and those fees are usually pretty hefty, $30 or more generally. So make sure that you're paying attention to the rules and regulations and the fine print of your credit cards to avoid paying any fees.